If you've spent more than 5 minutes on financial social media lately, you've probably stumbled across a variation of the ultimate get-rich-quick thesis. It goes like this. The global financial system is undergoing a massive reset. Central banks are replacing SWIFT with a new standard called ISO 20022. If you buy a handful of specific corporate utility tokens like XRP, XLM, XDC, Algo, or HBAR, you're going to be a millionaire because the global elite will be forced to buy your tokens for liquidity. It sounds perfect. It sounds official. It feels like you've uncovered insider knowledge. There's just one massive problem. It completely misinterprets how the banking system actually operates. Today, we are pulling back the curtain. We are stripping away the marketing buzzwords and looking strictly at the code, the actual text of federal legislation, and the hidden playbook of Wall Street. Because if you are investing your hard-earned capital based on the ISO 20022 narrative, you are missing the entire point of what makes a digital asset truly valuable. Let's break down the facts the hype channels don't want you to see.
First, let's dismantle the core illusion. ISO 20022. What actually is it? If you ask a hype channel, they'll make it sound like an exclusive blockchain alliance. But, according to the International Organization for Standardization, ISO 20022 is simply a data messaging standard. It is a language, a formatting tool. Right now, when traditional banks send money globally, the payment messages are rigid and text-heavy. The ISO 20022 upgrade simply allows banks to attach massive amounts of structured data to a single transaction, like tax IDs, legal purpose codes, and full digital invoice details. It is designed to prevent fraud and speed up compliance for the banks. But here's the golden rule of infrastructure. An administrative language standard does not dictate the asset being moved. Think of it this way. If a public school system upgrades its computers to run Microsoft Word, does that mean they are legally forced to buy up stock in a random local paper mill? No. They are just using a standardized formatting tool to type their own internal documents. When SWIFT or the Federal Reserve upgrades their networks to the ISO 20022 standard, they are doing it to move their own digital fiat dollars, euros, and yen more efficiently. They are not plugging into public, decentralized blockchains to purchase retail utility tokens. Central banks optimize for monopoly and control. They have absolutely zero incentive to pump the price of an asset held by retail investors.
But wait, the speculators will argue. What about the Clarity Act? That gives these specific compliant tokens a legal monopoly while the rest of crypto gets crushed. Let's look at the actual mechanics of the Digital Asset Market Clarity Act. The Clarity Act is a massive milestone for the entire digital asset industry because it finally replaces regulation by enforcement with clear statutory laws. It draws a clear line in the sand, separating securities under the SEC from digital commodities under the CFTC. For years, the core marketing pitch for these enterprise tokens was, "We are uniquely compliant. We have a monopoly on regulatory safety." The Clarity Act completely demolishes that monopoly. It creates a standardized legal highway for hundreds of crypto projects to register, comply, and achieve commodity status. By leveling the playing field, these tokens are stripped of their uniquely secure status. They are no longer special. They are just part of a massive crowd of newly legitimized assets.
Furthermore, the Act introduces the mature blockchain test. To be classified as a digital commodity, a network must prove it is sufficiently decentralized, and that no single corporation or foundation exerts control over it. This is where the enterprise narrative hits a wall. Many utility tokens rely on highly centralized foundations, controlled validator nodes, or massive pre-mined token allocations held by their parent companies. If they fail this decentralization test, they remain locked under strict SEC security rules, stifling liquidity and creating massive regulatory drag.
So if the banks aren't going to buy retail utility tokens, what is the legacy financial system actually building? Make no mistake, the banking cartel has a massive trick up its sleeve, and they are preparing a digital fortress to maintain absolute control. Their playbook has three main pillars. First, programmable central bank digital currencies, or CBDCs. Built natively on the ISO 20022 standard, these will allow governments to track every single penny you spend, implement expiration dates on your money, or freeze your access with a single keystroke if your compliance score drops. Second, institutional tokenization. Major commercial banks aren't utilizing public retail networks for their core business. Under the new legal frameworks, they are building private, permissioned, walled garden ledgers to issue their own fully compliant, dollar-backed stablecoins and tokenized deposits. When a megabank wants to settle a multi-billion-dollar transaction instantly, they will bypass volatile public middleman tokens entirely and use their own stable, pegged assets. Third, the custody game. The slickest move the banking system is making is absorbing decentralized assets into their own infrastructure. By pushing institutional ETFs and bank custody solutions, they encourage the public to buy paper derivatives kept inside traditional vaults, attempting to neutralize the self-sovereign power of digital assets.
But this is exactly where the legacy banking system hits a mathematical wall. And it's where the ultimate future of money reveals itself. We are moving rapidly into an era dominated by artificial intelligence and advanced robotics. In the near future, millions of autonomous AI agents will be conducting transactions with each other every single second, purchasing computing power, energy, and localized data audits. AI agents are entirely mathematical and autonomous. They do not have social security numbers, they do not have physical passports, and they cannot open traditional bank accounts. When a machine needs to transact with another machine, it requires three things: instant settlement, zero friction, and an asset free from human counterparty risk.
An AI agent will not hold its treasury in a volatile corporate utility token controlled by a foundation that can alter the supply or freeze the network. And it cannot rely on a banking system stablecoin that requires centralized corporate permission to move across borders. Instead, automated networks will naturally gravitate toward the only asset in human history that features absolute mathematical scarcity, total decentralization, and complete censorship resistance: Bitcoin. Bitcoin is pure protocol. It runs strictly on math and energy. It is a network with an unalterable 21 million hard cap, where the rules cannot be rewritten by a central bank, a corporate board, or a politician's committee.
While the banking system uses standards like ISO 20022 to dress up legacy banking 2.0 in a high-tech wrapper, they cannot fix the underlying reality of printing unbacked fiat currency. The future of global finance is a definitive barbell: highly regulated, programmable digital fiat used for high-velocity machine transactions, anchored entirely by Bitcoin as the ultimate, uncensorable global settlement layer for long-term wealth preservation. Don't let marketing buzzwords and corporate hype channels trade your hard-earned capital for empty promises. Look at the incentives, look at the architecture, and look at the math. If you found this unfiltered, factual breakdown valuable and want to navigate the digital asset space without the noise, hit that subscribe button. Drop your thoughts on ISO 20022 in the comments below, and I'll see you in the next video.